Gershon, your view on the demand for credit right now?
Well, I wish I could disagree with Rick. I like to disagree with him, but there's nothing really new here. It remains a very bifurcated market. You look at anything, I hate to use ratings classes, let's call it for better words, double B solid paper. There's a huge bid for it. And, deal comes, it's way oversubscribed, and anything with any hair on it whatsoever, you really can't give away. And, if you would have told us at the beginning of the year, high yield's going to be up 12, 13%, whatever it's up year to date, I would have said triple C's would be up 20, double B's would be up 6. It's kind of the reverse. Double B's are up close to 14, triple C's are up 5. And you would think that's an opportunity to kind of go the other way. We don't think so. We think the idiosyncratic risk and the credit risk, especially if we're right on the economy, is in the triple C area.
Do you agree with that, Bob?
There's certainly a lot of demand for high yield going on here. I do agree with Gershon. If we look at the loan market versus the high yield market, the loan market now has a yield that's 50 to 70 basis points higher than the high yield market. Usually that's inverted. So that's telling you that investors in the loan market are demanding more yield to hold those securities because that's where all the concern about the cov-lite and lack of covenants resides.
Priya?
I think we've gone from reach for yield to reach for quality, which is very different from where we were last year. If you look at fourth quarter of last year, it was the high grade stuff that actually underperformed. So I read that more as a liquidity event. What I'm reading now, the tea leaves actually suggest that investors are getting nervous about late cycle behavior. They're actually going up in quality. This is normally a good sign for treasuries, for example, because you would want something to hedge. The only hedge for a risk asset now is going to be long duration treasuries. So, I would still rather be lower in rate, higher in quality, even within the credit.
One thing I've spent the week trying to get my head around, I'd love the insight from all of you on this, is whether what we're seeing is a broader credit risk story or just pockets of idiosyncratic stress. So you bring up high yield, for instance, that spread between double B's versus triple C's. What's the signal there? If you look at leverage loans, is that just an aversion to floating rate, or is there some credit risk starting to bubble away at the bottom end of the market? What is it, Gershon, for you?
Yeah, I think there is credit risk at the bottom end of the market, and that's why you have to be cautious, and it's hard to make generalizations. I think there's parts of the levered loan market, and this is a little heresy from me saying it, I actually think there are parts that are cheaper than the high yield market. There is one risk, though, that's not credit related that I think investors aren't talking about at all, and maybe it's low probability given that we don't think yields are going to go up all that much. But if they did, people are buying a lot of paper maturing in, let's say, 5 to 7 years that have call dates in 1 to 2 years. And if what happened in 2013 happens, now again, it's not a base case, that paper is going to lengthen in duration tremendously and underperform by a large amount. Again, maybe not high probability, but big impact if it happens.
But Michael?
I think people aren't afraid of credit right now. I think every time they try to go up in quality or raise a little cash, they don't see the default rates going up, they don't see the dire earnings warnings, and then they're forced back into the market. And until we get further into the cycle and see things slow down more, and you see it in corporate earnings, money will continue to go into the credit market.
You think they should be afraid, though?
I absolutely do think they should be afraid, because I do think that the cracks there are real. I do think that what you're seeing in the loan market, there's been a tremendous amount of credit extended that's wound up in CLOs that doesn't have the covenants that you need. You can't just simply dismiss, oh, well, high yield market, it's energy. You are getting legitimate earning warnings. Somebody like Caterpillar is out saying, hey, guess what? Tariffs and the trade war are having an impact, and our guidance going forward is going to be lower. It's easy to get out now and wait it out rather than think you're going to be the person that picked up the last nickel in front of the steamroller.
Gershon, you want to weigh in?
So here's where I disagree. I share your concern in the short term about the high yield market. The question is, where are you going to go with the money? That's always the question. And how we view it is, you just have to expect lower returns. In essence, the very strong returns we've seen this year have borrowed from the future. And investors have to expect lower than coupon returns probably over the next year or two.
We've seen that in the year so far through 2019. If you could bring up the high yield spread here in the United States just over the last year or so, for much of the last 10 months or so, we've established this really, really tight trading range. And I say it tight, it's in and around 350 to 450. We get to the year-to-date tights, we bounce off them. We've just done that in the last couple of weeks. We approach 425, 450, and the buying starts again. Priya, what does that chart tell you? When do we start to break out of that kind of trend? And what does it tell you about the jitters of this market? Not once, not twice, but 3 times this year.
Tells you the pressure to sort of make returns and the fact that the US consumer, the service sector is still fairly resilient. You can't really point to any data and say this is showing that the consumer is falling apart, that default rate is going to pick up, which is why I think we're staying in that range. I actually think that's the range in which treasuries are also going to stay. So the 10-year stays 150 to 2%. It's when you start seeing, and I'm watching for PMI data, I think that's more leading than the labor market. If you see the service PMI number continuing to decelerate, in the months ahead, I wonder if then the macro environment will come up more for the credit investors where they say, really, it's about time that we cut back on the lower quality. So I think until then, until the data is okay, I think we stay within that narrow range.
Final word, Gershon?
Averages are misleading. Spread on double Bs is inside of 240. On triple Cs, it's over 1,000. Until you see that trend break, those are going to kind of offset each other, and you're going to kind of hover in this level.